Over the last year, inheritance tax planning has become an increasingly important consideration for both advisors and for their clients. Frozen nil rate bans have led to an increase in the number of estates liable for inheritance tax, and changes to business relief had led advisors to revisit their previously well-established planning decisions. Against this backdrop, HMRC has recently updated its guidance on replacement property relief as it applies to AIM portfolios. This update provides greater clarity on how relief applies. As a reminder, replacement relief is part of the wider business relief legislative framework. Broadly, it allows a client to dispose of an asset that qualifies for business relief and replace it with another qualifying asset without restarting the 2-year ownership clock, provided certain conditions are met. This means that inheritance tax relief is maintained. In principle, this has always allowed flexibility. Companies can be sold without undermining long-term IHT planning. HMRC has now clarified how these rules apply in practice, particularly where replacement assets offer a different level of inheritance tax relief. The updated guidance confirms that replacement relief is subject to an important limitation. The amount of inheritance tax relief available on the replacement asset cannot exceed the relief that would have applied had the original asset not been replaced. HMRC specifically references AIM shares in its example. AIM shares now attract 50% relief, whereas some unlisted trading company shares may attract 100% relief. If an investor sells their AIM shares and reinvests these funds into assets qualifying for a higher level of relief, HMRC states that until the new asset has been held for 2 years, relief may be restricted to 50% based on the original AIM holding, rather than increasing to 100%. So what does this mean in reality? Imagine a client has £500,000 in AIM shares, on which they're getting 50% inheritance tax relief following the changes that were introduced in April 2026. The client decides to sell those shares and reinvest into an unlisted trading company, which would normally qualify for 100% inheritance tax relief. If they die within 2 years of the reinvestment, HMRC would still look back at the rate of relief available on the original investment, meaning only 50% relief applies. It's only after 2 years that the investment would qualify for 100% inheritance tax relief. So put simply, switching from AIM doesn't improve the inheritance tax position straight away. For up to 2 years, the client is still effectively at the original 50% level. Now, this is not a new rule. The guidance simply reinforces HMRC's approach and removes any ambiguity around how they expect it to apply in practice. This matters now for 2 key reasons. Firstly, more clients are actively reviewing inheritance tax strategies. Market volatility, policy change, and greater awareness of inheritance tax exposure all mean more portfolio movement. Secondly, changes made as part of the standard portfolio management may have unintended inheritance tax consequences if the replacement rules are overlooked. HMRC is effectively emphasising that replacement relief is about continuity, not enhancement. It helps preserve relief, but it doesn't allow that relief to increase simply through switching assets shortly before death. A clear understanding of replacement relief helps protect clients from unexpected outcomes and allows advisors to give clear, well-structured planning in an evolving inheritance tax environment.